Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We will also share our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was down 0.6% for the month ended January 2025. The Nifty Midcap 150 index was down by 6.1%. Whereas the Nifty Small Cap 250 index was down by 10.7% in January 2025. Sector-wise, Nifty Auto 0.1%, Nifty FMCG minus 0.2%, and Nifty Financial Services minus 1.2% were the top-performing indices, whereas Nifty Media minus 13.1%, Nifty Realty minus 12.4%, and Nifty Pharma minus 8.4% were the laggards. Global indices ended the month of January 2025. On a positive note, Dow Jones was up by 4.7%, Nasdaq was up by 1.6%, while Financial Times Stock Exchange 100 was up by 6.1%. The India Volatility Index saw an increase in January 2025. It was at 16.25 compared to 14.45 in the previous month, up by 12.5%. The Chicago Board Options Exchange's CBOE Volatility Index, CBOE VIX, saw a decline in the month of January 2025 and was at 16.43 as against 17.35 on the previous month, down by 5.3%. Foreign Institutional Investor, FII, were net seller for the month of January 2025. Net FII outflows were rupees 72,677 crores. Domestic Institutional Investor, DII, bought stocks worth rupees 86,592 crores, whereas mutual funds were net buyers worth rupees 57,619 crores. Nifty 50 forward PE trading greater than 1 standard deviation over the mean PE. Nifty Midcap 100 is trading near 2 standard deviation above the mean forward PE. Finally, the much-talked-about correction has taken place. Small caps suffered a sharp fall of nearly 11%, mid-caps by 7%, and large caps by 2%. This sharp fall was due to fears of trade actions that the new U.S. president could implement, as well as possibility of rising taxes in our budget. This drawdown was on back of retail investors booking profits and continued sale by foreign portfolio investments FPIs. While aggregate market valuations have not declined significantly, many stocks have declined by 25 to 40%, which is an opportunity for the medium term. India's Union Budget 2025 promises to reverse the sharp decline in consumption momentum while maintaining fiscal prudence. The Union Budget's salient points were fiscal conservatism and no new taxes. In fact, income tax levels have been reduced by revising the slabs, and hence people with incomes of rupees 12 lakh do not pay any taxes. That is an incremental stimulus of rupees 1 trillion, which has a multiplier impact as well. There has been a slowdown in consumption, capex, and global trade. Liquidity in the economy had slipped into deficit due to fiscal conservatism and execution in key projects not keeping pace. In 2024, India faced inflation in the food basket, as well as a slower recovery in exports. We are now witnessing a reversal of many of these trends. Private Final Consumption Expenditure, PFCE, accounts for more than 60% of India's GDP, and a slowdown in consumption will need to be matched by significantly higher growth in capex on a sustainable basis, which is difficult to maintain. Recognizing these issues, the Union Budget has reduced tax levels for the middle class. The budget has also continued its path of controlling the government's fiscal deficit, implying that yields will remain benign and not crowd out finances to the private sector. In our view, while this is a step in the right direction, it may not be adequate, and GST rates may need to be reduced as well. We do anticipate lower food inflation and exports improving gradually. helping create jobs and improve consumption. The Union budget's incremental allocation to defense and railways is not significant, implying that the growth momentum here could come off. Improving liquidity conditions and the Reserve Bank of India infusing adequate liquidity and also perhaps allowing freeing up credit restrictions could benefit the financial services sector, including banks and NBFCs. The U.S. government has fired its first set of tariffs against Mexico, Canada, and China. The outcomes are not known yet, but it has certainly highlighted the reason as to why India needs to bolster the domestic economy, led mainly by consumption. The U.S. is India's leading trade partner with bilateral merchandise trade of nearly $121 billion in fiscal year 2024. Although India's contribution to U.S. imports is small, it is a large portion of our exports and hence we remain vulnerable. India's exports basket comprises of IT, pharma, textiles, engineering goods, etc. If India is not impacted by tariffs significantly, then some recovery in trade is expected and benefits trickling through to the domestic economy as well. We need to accept that import tariffs are a way to bridge the fiscal deficit in the U.S. and are here to stay. This may cause some excess capacity in some parts of the manufacturing chain, causing price and volume disruptions globally. Should these policy measures impact China significantly, then we could anticipate corporate defaults to rise there, leading to opportunities for Indian companies. India may also adopt a similar strategy of raising import tariffs and reducing domestic taxes, be it the GST or income taxes. This could become a new paradigm which is beneficial to the manufacturing sector, though it may take some time to reflect in corporate bottom lines. Our portfolios were impacted by several cross-currents, and we are changing our allocations to factor in the new realities of slower capex growth and higher consumption growth aided by financial leverage as well. Hence, we have increased our allocation to domestic consumption and financials and will continue to do so. Consumer companies have lower capital requirements, higher capital efficiency, and free cash flows. They remain an expensive basket, and hence our allocations will be measured. In the case of the financial services, we see reasonable value in the space. Select mid-cap and small-cap valuations are more reasonable post the sharp sell-off as well as PSU stocks. We believe that while there is room for optimism in the economy, the markets have become nervous. This can throw up interesting opportunities. Similarly, export curbs can enhance competitiveness of Indian companies and boost exports in areas such as light engineering and chemicals, apart from traditional areas such as garments. In our view, corporate earnings are expected to improve from here on as the adverse base is turning favorable. A confluence of positives could then play out, improving liquidity, higher domestic consumption, exports growing as China +1 actually plays out, and lower raw material costs improving margins. Volatility is expected to remain a key challenge in 2025 as well, and hence we are looking at safety as a key aspect rather than growth in our portfolio. As regards fresh allocation to equity, market returns are expected to remain benign in 2025, and hence a measured allocation strategy with systematic investments may be considered as a preferred route.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.